Welcome to Trading Nation. I'm Frank Holland. Target, Best Buy, and Amazon kicking off their two-day sales events on Tuesday, marking the beginning of a longer holiday shopping season. That shift to e-commerce likely to benefit the transports. A reliance on online shopping during the pandemic already giving a big lift to FedEx and UPS so far this year. For more on how that activity could continue to impact the logistics industry, let's bring in Bill Baruch of Blue Line Capital, and by phone, Boris Schlossberg of BK Asset Management. Gentlemen, thank you both for joining us. Boris, we're going to get started with you first. Of course, UPS and FedEx, they've been the beneficiaries of this quote-unquote COVID economy. Over the last 3 months, their stocks far outperforming. But over the last week, as we've seen kind of what appears to be a second wave, the stock's trading pretty much in line with the S&P. Do you still see more room for these stocks to grow? And do you still think there is more room for people to buy more online?
Oh, absolutely. The answer to both questions is definitely yes. As you said, both of these stocks have been the COVID economy darlings because it's been a massive, massive transition to online shopping. And most importantly, I think completely even underestimated by some of the markets, is that the older cohort, the older population, which is most vulnerable to COVID and is one perhaps that's least technically savvy, has really probably taken much more towards online shopping than ever before. And I expect this trend to continue not only just through the shopping holidays that Amazon and Target are putting on together and Best Buy are putting on together, but through the holiday season itself. I think the holiday season itself will essentially be mostly virtual, mostly digital. That should be massively positive for both FedEx and UPS. Now, FedEx has outperformed UPS up to now. They've both outperformed the S&P, as you said. But I think actually going forward, I really like UPS as a trade here. It's a very, very solid company. The parcel delivery model is what they're optimized to do. This is going to be the big model as we go into the holiday season. And to boot, they're not that expensive, and the yield is more than 2.5% on a dividend. So at this point, it's both a value and a potential growth play going into the holiday season. I think as you see this record numbers explode, the market is going to show its enthusiasm by bidding the stock up.
You know, Boris, that dividend story is one that doesn't get talked about a lot. Carol Toomey has said that she does plan to maintain that dividend. So that is a key part for a lot of investors. Bill, turning things over to you, a little bit more of a technical look. Now, both FedEx and UPS, both of them trading right at their all-time highs, if not just maybe a percentage underneath. Is there more room for this stock to run? I want to bring up that same point to you. Over the last week, both of these stocks, as we've seen, what appears to be a second wave, they've traded kind of in line with the S&P. Also, is it maybe too much of a good thing for UPS and FedEx, this additional volume? Do you see that having the potential to hurt their margins and the stock in turn?
Well, the S&P's had a pretty good 1 week run itself, so I'm not too concerned about it staying in line with it. However, Boris makes a great point, the virtual holiday season, and I think that's something that's bringing a tailwind maybe starting now and should continue to bring a tailwind. Overall, though, as you pointed out, they're either at their highs or almost at their highs. UPS has broken out above its previous high this year, and it has a latest leg of its breakout right now. It stays above 166. Path least resistance is absolutely higher. I'd be worried if it does start to pull back a little bit, get the 50-day moving average creeping in, coming in just below 160. So if we start breaking below there, you know, you want to be looking. We know this market's vulnerable. I can see a sharper pullback, and I don't want to say we're going to see 135, but that's where we could find the market falling in a broader correction. So I think what's important with a lot of these markets, especially those at record highs, is to know your buy levels. And then looking at FedEx, though, where UPS is broken out, FedEx is right at that previous all-time high from January 2018. So I'd be a little more cautious on FedEx here, waiting for confirmation, waiting for that breakout. And if it doesn't, we could see that fall back, as well. But 225, 240 is where I want to be a buyer in FedEx upon a pullback. Now, lastly, keep an eye on the iShares Transports ETF, IYT. It's driven by the rails mostly, but you definitely have FedEx and UPS in there. And if we start to see that breakout, which it is starting to, then you could see broad tailwinds across the sector, and that would lift these stocks also.
So, Bill, great point. The rails, they've also outperformed the S&P in recent months. So I'm going to ask you first and Boris second. Is this holiday peak growth, is this e-commerce growth and everybody switching to online buying, is that already priced into these stocks?
I do believe the markets price things in and are very rapidly do so, even more so today, more quickly today than they did years ago. So I do think there is a good amount priced in here. Now, I do think there is still upside as the economy still shifts, and I still think there is some doubt of how much the economy can shift virtually, as well as needing the rails, needing the shipping, and from that. So I still think there's tremendous upside in these stocks.
So, Boris, same question to you. Is it priced in? And also, are the holidays just too much of a good thing? This volume, FedEx and UPS, they found a way to make B2C profitable, even though it's a third less profitable as B2B. But can they continue to do that as we all begin to buy things online, and especially start to buy gifts online?
I think they can. I mean, technology these days is absolutely amazing, and they have tremendous amount of investment into IT to constantly rationalize costs. I also think this is a secular change. I think a lot of changes that we're seeing from COVID, I think the default assumption that we're going to go right back to kind of normal pre-COVID days really is going to fade by the wayside. There's going to be a lot of behavioral changes that are going to be set in stone as we go forward, and they're going to be just long-term beneficiaries of that trend. So to me, it's not just simply the first month or the first quarter trend. It's really going to be a multi-year trend from which they're going to benefit tremendously as more and more people discover the ease, the joy, the flexibility of virtual shopping. So they're going to continuously improve their margins, and the growth is going to be there, in my opinion. Yes.
Well, just to put this growth in perspective for our viewers, the last estimate I saw is that year to date, 78 million packages are shipped per day here in the U.S. During the holidays, that's supposed to jump up to 122 million during the holiday peak season. Bill, I'm going to go back to you. What do you think that means for investors when they see that kind of growth, and for this next quarter, which is obviously a big quarter for both UPS and FedEx traditionally, but especially this year?
I mean, I think we're going to see these stocks, the retail stocks. I mean, the Amazon, Target, the Best Buys, who we're focusing the start of this conversation with, they're all going to perform very well. I think we're going to continue to see those perform well. We're going to see the rails, we're going to see the transports all perform very well in the coming year. That shift is going to continue. So I think the portfolio is going to have to adapt, and that's ultimately too going to create waves of buying. As I pointed out with the IYT, you get a breakout there in that ETF. It's going to drive tailwind in the stocks that's within that ETF. And I think the same way that you're going to see here as portfolios shift to capture a lot of this, the shift has just begun. As Boris said, it's a multi-year thing happening.
But Bill, here's the question. We know we're going to see revenue growth. We know we're going to see volume growth. Will we see commensurate earnings growth?
You would have to think so. And I mean, especially with interest rates as low as they are right now, the market isn't overvalued relative on an earnings point. So I think there is room to see earnings growth, and a lot of these companies are going to take hold of that earnings. I don't think it's a definitive pie that's been there in the past. I think that pie is expanding overall. So I do think we're going to see earnings growth in certain sectors, and these being some of them.
Oh, sorry, Boris, I don't want to cut you off. Jump in.
No, it's okay. I was going to say, and also to the point of valuation, these are not trading at Zoom-like multiples. They're trading at very, very placid multiples. So there's still a valuation opportunity here in terms of using. They're just old school. They're basically old school companies that are adapting to the new economy really, really well, and they're going to be huge beneficiaries of this new trend, I think.